Hey, good morning, everybody. Welcome to How to Build a Winning Portfolio. You got John Hopkins here. It's Saturday, May 17th. I'm coming to you live from Charlotte. I actually live in Charleston, but came here for the weekend to be part of the PGA Championship with Tom Bowley. He's going to jump in just a second. I want to take this opportunity to welcome everybody who's taken their time out on Saturday to join us. I think you're going to find this to be an extremely valuable event. I want to say, if you like what you see, hit the like button and subscribe to our channel. That's really important as we build our community that just continues to grow. We've been in this arena in the market for over 20 years now as earnings beats. And I want to bring my partner in here, Tom Bowley. Make sure he's on the scene here. Hi, Tom.
Hey there, John. How you doing?
Good. I'll tell you something. I was the market has been pretty impressive. You know, the past couple of weeks, just like just when it looked like everybody was going to get out of the market, here we are getting right back to really a couple of strong days away from an all-time high. And you've been very steadfast in your analysis. I'm not going to get into all the other analysts who have just shifted daily and hourly their forecast, but you really have been one of I think, the most steady in terms of your positivity about the market. And I think people will be really interested today about how to build a winning portfolio. So I'm just going to step to the sidelines. I'll be back a little bit later and let you take it away.
All right. Sounds good. Yeah. First of all, welcome everybody. Really glad that you're able to join this morning. Those of you who watch on the recording later, get the recording. Thanks for checking this out. I think you'll find it to be pretty educational. That's what we try to do at Earnings Beats. We have we do a lot of research, independent research that we share with our members. And I think the combination of that and the market guidance and, it's the guidance, the education, and the research and all that we do that I think really provides tremendous value for our clients. And yeah, as far as the market goes, I've developed some what I consider to be time-tested ways of taking a look at the market to get a better idea of when the market's very risky and when it's better to maybe be sitting on the sidelines. Those who are really aggressive could be shorting. And then you get to times when the risk starts to flip. And after the market's been down quite a bit, it's generally a good idea to be thinking about getting back in. I mean, that's what history tells us. But unfortunately, many of us listen to way too many media outlets and folks who have no history of doing independent research and following the market. And so they tend to do no better than the individual traders, and they get caught up in a lot of the emotions and so forth. And I think the way to take that out is simply to focus on the charts. And that's what we're going to do a little bit today. Talk a little bit about how you can follow the charts and follow the truth about what really is going on in the market, and try to steer clear from trying to invest, move your money around based solely on emotion. I think that's really, it's just not a good practice in trying to build your financial wealth over time. Because we get very emotional. We get caught up in the greed to the upside. We get caught up in the despair and everything going on to the downside. So anyhow, what we want to do today in How to Build a Winning Portfolio is talk a little bit about the overall market and calling direction. I think if you're going to try to build a portfolio, it certainly makes sense. You want to call direction. Well, let's go ahead and pull that agenda up for today. And so what we're gonna do is we're gonna talk a little bit about a proven strategy. Number one, I think just doing your own independent research qualifies as a proven strategy if you do it and you over time continue to refine it and get better and better. But we have different things that we like to do at Earnings Beats, and one of those is we have a model portfolio and an aggressive portfolio. That we've had. The model portfolio we started in November of 2018, and I believe the aggressive portfolio was, I believe, in May of 2019. So it was just 6 months later. And so we'll get into that and talk a little bit about what we do with that. Calling market direction. we could have probably a 2 or 3 hour webinar on that alone. So I'm really just going to touch on a few things that I think are important that we look at and try to remain objective about the market. I think objectivity is one thing that's lacking. When a lot of folks look at the market, they've already kind of got a preconceived idea about where the market's going to go, and they're looking for things to support their preconceived ideas. And I think if you try to get away from that, again, remain objective, I think you can look at the charts, see the truth, and make calls that are independent of a lot of the stuff that we see online and on CNBC and other media outlets. Third thing we'll talk about is top-down approach. That's the way we do it at Earnings Beats. Try to find some of the key leading areas in the market and then kind of work your way down from there. Throw in a little seasonality because there are certain areas of the market that tend to do well at throughout different times of the year, and that's been proven over time, over long periods of time. So it's a little combination of things that we do in trying to come up with our top-down approach, but it all ends up winding down to the stocks or the ETFs. In this case, we're going to talk mostly about stocks today. But if you're building a portfolio of stocks, then you need to know what areas of the market are working. I mean, if you want to beat the market, you need to find stocks that are beating the market. I mean, that just makes common sense to me. If you're looking at trying to beat the market with underperforming stocks, I mean, maybe you can do that over time. But if you're trying to continually, if you want to build a winning portfolio where you're looking for momentum and so forth and trying to make money every quarter, I think finding stocks that are downtrending relative to the S&P 500 is not really going to help your cause. You want to find stocks that are outperforming and ride them as long as they continue to outperform. And then finally, it's all about timing. I mean, once you've found your top areas of the market and you look and you find some of the stocks that you like, sometimes you're just really overbought. I mean, if you look at the rally we've seen over the past 5-6 weeks, I mean, it's crazy how fast we've gone up. And I mean, we've got RSI on some stocks up into the 80s now. You've got stochastic around 95, maybe higher on some indices and areas of the market and various stocks. So very stretched PPOs. All of these are momentum oscillators that I'm talking about that, can get very, very overbought. And so sometimes you might have great stocks, but if your timing's off and you get them after they've made huge runs, sometimes, if you get in and they immediately take a pullback, you get very concerned about them. And, then you start hearing the media and, oh, here we go. We're going back down. This is going to be bear market 2.0. And you get swayed emotionally, and then you start taking losses, and then you see the market rebound, and it's just a cat chasing its tail just over and over and over again. It's very difficult to get out of that cycle. So what we focus on is looking for great stocks, and we hold them for a period of time. So let's go ahead. I'm going to go ahead and share here. Hold on one second. Let's go ahead and I will share my screen for you. All right. So one thing that, before you signed up for this, you may have seen this chart, and I thought it was really interesting to bring this up, because the first thing you really want to do is you want to find that proven strategy. I mean, you want to find something that's worked. And, when you have something that works, you want to be careful about changing too much because it's working. So you stick with what's been working. And we started out back in 2018, November of 2018, putting together a model portfolio. And the way every stock, and I'll talk about this a couple more times throughout this event, but every stock that goes into any of our portfolios must be in our strong earnings chart list. A strong earnings chart list for us, the chart lists come from Stock Charts. We use the Stock Charts platform. You don't have to use the Stock Charts platform, but we do. And it's really more of a watch list. Think of it as a watch list. And it's filtered by looking at companies that beat revenues and earnings per share in the latest quarter, not the last 10 quarters, 4 quarters, 7 quarters, whatever, just the last quarter. We want companies that are showing not only that they can meet expectations, but they also can beat expectations. I mean, those are companies that are operating and executing at a very, very high level relative to other companies that are coming up short, as far as their estimates go. And so we started back in 2018 with this concept because members would come back to us and say, well, on the strong earnings chart list or on this watch list that you put together, there's 300 or 400 companies, can you just shorten it down to a list of maybe 10, 20, 30 stocks? And so that's how the model portfolio was born. I went back and I said, okay, well, let's look at some of the areas that are doing really well, and then we'll find stocks within those areas that are showing great fundamentals in terms of beating the market top and bottom line. And that ought to be a pretty good approach, to putting together a nice portfolio. So what we started doing was taking 10 stocks and we try to get them in different areas of the market, not necessarily all different sectors. I'll go back to Warren Buffett, when he talks about diversification, and I'm going to paraphrase a little bit. I don't know his exact quote, but he said diversification is for those who are ignorant in the market. And he didn't mean that as a slight to folks who want to invest and really just don't know how to invest. He said, if you're getting in, you don't know what you're doing, invest in the S&P 500. That's, fully in diversified, multinational, list, 500 companies doing business all around the world in all 11 sectors. And you'll get a good representation of everything. But he said, if you know what you're doing, you don't want to diversify. You want to invest where you feel most comfortable about the market moving higher. And if you look at his portfolio, it's not that, Berkshire has, 5,000 companies in it. They buy companies that they believe in and they hold them. Now, as far as our portfolios, that's kind of what we do, but we change out every 90 days. And so we've been doing that since 2018, and the results speak for themselves. I mean, we have every quarterly portfolio webinar that we've done since November of 2018 recorded, and they're on our website. You can go back as a member, you can go back and listen to any of them you want to. I'm pretty sure they're all there. But we do this every 90 days. So it's November 19th, 2018 is when we started. And then we've done February 19th, May 19th, August 19th, and November 19th. In that cycle, that's what we do. We have one coming up on Monday, which is May 19th. And that's when we're going to end our current portfolio, and we're going to be announcing the 10 stocks that are going in for the next 90 days. And we just rinse and repeat throughout the year. Now, the reason we pick those dates, the 19th, if you notice, it's the 19th of the second month in a calendar, within a calendar quarter. So for instance, first quarter, it's going to be February 19th. And the reason we pick it is because we want to get through earnings season. And the majority of companies have reported by February 19th in the first quarter. Likewise, we're now in the second quarter and May 19th. Just about all the big companies, many of the companies that will move the market have reported through May 19th, through Monday. And so we'll be looking at all the companies that have reported, find the best ones in the best areas of the market, and we'll put them into a portfolio. And that's simply how it works. It's that simple. This isn't complicated. Very simple. And look at the results. This is now going since November of 2018. So this is now, 6.5 years that we've been doing this. It's a pretty significant time period. And here is what our model portfolio has done. If you put $100,000 into it, just followed it to the T the way we've created it, it would be worth $361,000 today. The NASDAQ, if you invested in the NASDAQ on November 19th of 2018, today you have about $250,000. It would grown from 100 to 250. Nothing wrong with that. One of the ARK funds, if you know Kathy Wood, she's probably one of the big celebrities in terms of, maybe not as much today as she was maybe a few years ago. But she's had a lot of money flowing into her funds, and a couple of the key, maybe flagship type portfolios that they've put together, really ETFs. Couple of the ARK funds. So it's the ARK fund, the family of funds is the ARK funds. And so ARKW and ARKK are a couple that have a lot of money that's been poured into it. And you can see ARKW is just below the NASDAQ. So it's almost kept up with the NASDAQ. This ARKK has not even kept up with the S&P 500. And then finally, this is the Innovative IBD, Investors Business Daily, Innovator 50 ETF. So they're constantly putting in what they believe are some of the best, most innovative 50 stocks out there. And look at what they've done. 100,000 invested 6.5 years ago, still sitting around 100,000. Stock market's gone up a lot more. You can see here's the S&P 500, here's NASDAQ. But a lot of folks like to follow the IBD approach. I would say last 6 years, at least in this particular ETF, not a good idea. Let me show you. I'll show you the FFTY. I'll bring up a chart here. So this goes back 10 years, but this is where it was back in 2018. I can kind of zoom in here a little bit. 2018, middle of November, would have been somewhere probably right around the middle of the quarter. So something in the neighborhood of around, let's go back down here. So right near 30. And here's where we are right now, 29.29. Now that, when you compare it to like the S&P 500, just pull that up. And here's the S&P 500, the middle part of this quarter, and look at where we are. So, you just can't take something at its word or, without doing some research and studying into it to find out exactly how these different investment vehicles have performed over the years. That one, not very well. And it's a growth fund. Growth has been leading value for the last 12 years since the secular bull market started. And you're a growth fund and yet you haven't gained anything. Pretty disappointing. Anyhow, here is the model portfolio. And I wanted to bring this up and show this. This goes back to when we started it back in November of 2018. And I just want to point out that this is not like peachy every quarter. We've gone through some excellent periods where we crush the market. And then we go through periods where it's not been so great. When we topped back in 2021, went into 2022 during the cyclical bear market, we remain invested 100% of the time in these portfolios. So we do try to look at what we think is going to happen in the market. And sometimes I do make bold calls. I think the market's going to go down. And I try to, buffer the portfolios a little bit, maybe a little bit more defensive or more value oriented, which in my opinion, during bear markets generally will do better. So we, the whole idea for me when I think about it is if our portfolios can just keep up with the S&P 500, if they can just stay close to the S&P 500 in down periods, we tend to shine. Our portfolios tend to do very well when the market's doing better, assuming that growth is leading, because I would say that I would categorize our portfolios as growth, aggressive for the most part. Model, sometimes we can get a little less aggressive. The aggressive portfolio, which has outperformed probably the S&P by, I don't have the numbers in front of me, but probably by about 40%. So not nearly as strong as the model portfolio, but still very solid outperformance. That can get very aggressive and we can have some really wild swings in that particular portfolio. But the model portfolio, you can see over time, this is where we are. This is through Tuesday. So I think what what you saw here, I don't know when that was as of, but it was probably as of last Friday. And then we had a couple really good days on Monday and Tuesday. And that is where May 14th. So May 14th was, I guess that was Wednesday. Yeah, Wednesday. So through Wednesday's close. So we still have to update Thursday and Friday, as John mentioned at the top. Last couple of days have been a couple of really good days for us because PGA Championship. Many of you all know I'm a really big golf fan. and PGA Championships 20 minutes from my house. So we've been spending a little time out the PGA. So I haven't updated this the last 2 days, but I'm sure it's higher. Market's been up the last couple of days. But anyway, you can see it's working its way back near the high before we had the meltdown over the last 3 months. Many folks, I mean, I talked back in January and February. I don't follow these portfolios to a T. People ask me, do you invest? Do you invest in these? And I say no. And the reason why is you have to hold 90 days. I'm not a buy and holder. I'm a trader. I can tell you that I do trade a lot of the stocks in these portfolios because I believe in these stocks. But I'm not a buy and holder. It's just not my strategy. This portfolio strategy was developed from members, many members who would write in and say, hey, I work all day. I don't have time to follow the market and get in and out weekly or, bi-weekly or whatever. Do you have something that you could just kind of put out there and hold for a period of time? And that's how the portfolios were born. So anyway, that's kind of gives you a little bit of history and how we've done. But I mean, right now, 278% higher since November 19th, 2018. And the S&P 500 is up 119%. I'd say we've done pretty well over time. And I feel pretty comfortable going forward. I do want to point out we are not registered investment advisors. I always like to point that out because sometimes I think members just say, hey, well, just tell me what to buy. Well, I don't know anything about our individual members' risk profiles. I can't do that. We have some folks who are more income oriented. They're in retirement. Their retirement money needs to last. They can't afford to go up and down or have a couple really bad quarters in a row. And so that's completely different than somebody who's working still in maybe their 30s or 40s, got 25, 30 years to retirement, want to be really aggressive in the market, try to catch some of these growth stocks during their growth spurts. Two very, very different types of members. How would we just send out something that's, supposed to be, fits all sizes kind of a thing? I mean, it just doesn't make sense. So we are not registered investment advisors. Everyone, we try to educate. We do a lot of research that we pass along. We provide market guidance, tops, bottoms, that we call in the market. And then it's up to members to take all this information and use it the best way possible for themselves and their families. But the portfolios are one thing that we do that we update every quarter and continue to track daily and continue to update. We don't always update the results daily because we just don't have time, but we do try to keep it updated at least once a week and usually a couple times during the week as well. Anyway, last thing I want to show you here, or actually I got two more little slides here on this particular segment. But this is the big picture chart. And this is what I show our members every single week in our weekly market report. It comes out on Mondays. We do a daily market report, but the weekly kind of focuses more on long-term. And this is a chart that I start off with every single week, bar none. Because the one thing you have to get ingrained in your head, everybody always wants to call a market top. Everybody always thinks the market's going to go down. I mean, you got all kinds of reasons. I mean, it could be that, you're worried about inflation. You're worried about stagflation. That's a big, big word going around right now. You're worried about interest rates. You're worried about recession. You're worried about politics. That's a big one. If you're a Democrat, you think when a Republican goes in office, the market's going straight down. If you're a Republican and a Democrat's in office, you think the market's going straight down. I can tell you since 1950, there's been very, very little difference in the market, depending on who's in the White House. So I don't pay attention to politics. Politics, as far as I'm concerned, throw out the window. I'm looking at the charts, and I don't care who's in office. I say that when there's a Democrat in office. I'll say that when there's a Republican in office. I don't care. Don't care about talking about politics. I was taught when I was young, you don't talk politics because you're just going to, nobody changes their mind. It's just a fight. So do you want to make money or do you want to, invest based on politics? I'll give you that question. If you want to make money, ignore politics. Don't you need to separate your money from your political opinions. And I'm just going to leave it at that. Here's the history. Typically in the S&P 500, we go through these grand super cycles. We'll go through periods of lengthy periods where the market goes nowhere. We just go up, down, up, down, up, down. And over 10, 12, 15 years worth of time, the market does nothing. Then we go through these 15, 20, 25-year cycles where you have a secular bull market and the market just ignores everything. Sure, we'll pull back. We'll go into short-term cyclical is short-term bear markets that usually last 3 to 6 months, maybe even 9 months or a year. Going beyond that's a little unusual, but it can happen. But it's usually contained within a year. And sometimes just one we just went through, literally, it was down in 5 weeks, 6 weeks, February 19th to April 7th. So calculated, I don't know, 7 weeks, maybe, whatever it was, top to bottom. I mean, I said back then, I thought it was a cyclical bear market. Back at the beginning of April, started talking to our members, and even in some of the free content that I put on YouTube and so forth, talking about, hey, I'm back in the market. When the market goes down 15 or 20%, when you look at history, 15 or 20%, that generally is a great time to buy. I know the news is bad. That's why the market's down. Forget about the news. Pay attention to history. Pay attention to these secular bull markets, because you almost always have, great opportunities to jump in when you're seeing these pullbacks in the market. I've been around a long time, and I've had 3 secular bear market declines of 50% or more. 3 in my lifetime. You can probably look at me. I'm not 20. I'm not even 50. I'll give you that. I'm going to stop there. But there have only been a few times when the market's really gotten nasty. And so if you're sitting back, always thinking that we're going to get one of those massive declines where we're going to go from a top and we're going to drop 50%. Well, I mean, I could go all the way back to 1950, 75 years, and we've had one big drop here, more than 50%, 73 to 70 through 74, early 2000 to 2002, and then again in the financial crisis. Those are the only 3 drops since 1950 where we've gone down 50%. And the fact that we had 2 of them here in just the last 25 years makes me feel even stronger that we're not having another one. Not for a while. So I'm a secular bull market believer. Some people think I'm a perma bull, and that's fine if you want to think that. When I see signs that the market's going to roll over and sell off, I'll tell you about it. But anyway, I like to follow this. I believe we remain in a secular bull market. I said that in 2018 during the trade war. I said it in the pandemic. Right in the middle of the pandemic in 2020, I said this is a healthcare crisis. It is not a financial crisis. And we bounced right back out of it in no time, back to all-time highs. 2022 literally called the bear market before it ever began during our Market Vision event, January of 2022. I said back then on January 8th, I believe it was, or 7th, something like that. I said I thought we'd go down 20 to 25% in 3 to 6 months. We went down 22% or something like that in 5.5 months before we bottomed what I thought was the bottom in June of 2022. We did end up going down slightly lower a little bit later in the year. But if you got in May or June actually, of 2022, which was right here, you'd have been pretty darn happy. I mean, the fact that you went down a little bit in October, yeah, it wasn't the best, but still, I think from the time, that June bottom to the October low, maybe it was another 3% or something to the downside. And then the market just rallied, had a huge 2023, 2024, one correction in 2023, and then came into 2025. And I started talking about it again, January, February, and I'll show you a little bit in the calling the market part of this event. I'll show you some of the reasons why I call what I call. Last thing I want to point out here about, just following a proven strategy. Here's our strong earnings chart list. Right now, we have 545 companies because we just came out of earnings season. So we got a lot, and a lot of companies beat. This is a chronological order over the last 3 months. Any companies as they report, if they beat top line, beat bottom line, they're liquid, trade over $5, and look fairly decent technically, or they're part of a group that looks really good technically, then they get added. And it's chronological. So the earlier numbers are going to be companies that reported 3 months ago, 2.5, 3 months ago. And then we will get to the bottom. And these are companies that have reported the latest. Now, I have not updated this for last week. I do it every Friday or Saturday over the weekend. So I'll be doing that this weekend and updating it through May 16th, which is, like I said, Friday. And I'll have so that's, companies like Cisco reported last week, Applied Materials reported last week, a few big names, but for the most part, the big names are reported. Anyway, this will get updated. But from this list, when we announce our portfolios on Monday in an event with our members, all the companies that we talk about that we include will be on our strong earnings chart list. And that's just we want to make sure companies have strong fundamentals. We also want to make sure they have strong technicals, that they're leading stocks, leading industry groups. And this is kind of headquarters, if you will, of or the war room. If you follow the NFL draft, every NFL team has a war room. Well, our war room are these 545 stocks. If you're not among those, you're not getting in. And again, it'll change a little bit because we're going to be adding for this past week. But yeah, that's how we do it. So let's move on to calling the market. First thing, the most important thing to me in the stock market is price action. So the problem with price action when you're calling a top is the price action doesn't tell you anything when you're at an all-time high. Price action just tells you that you're on an all-time high. So if you're simply following price action, you're not going to get out until the market pulls back and until it starts to really sell off. And then you start getting panicked. Then you follow your emotions, which is never a good thing in the market. You need to start objectively looking at the market when it's topping, when it starts to, some secondary signals all start coming together and start saying, hey, this looks like a top. Whoa, this looks like a top. And I look at this chart. This looks like a top. Oh, this one looks like a top. And you start putting it all together. I always say it's like putting a jigsaw puzzle together where you've got all these different signals. And when you put them together, you can see the picture perfectly. When you're holding one piece up and you say, well, this is a bearish piece, you can't see the rest of the puzzle. And so I talk a lot about my secondary signals and how I use them to call market tops and bottoms. And then I'll get some folks that'll take pieces of what I've talked about in the past and say, now they're 2 or 3 years down the road. And they say, well, you said, if there's rotation to defensive stocks, that means that the market's topping. Not exactly what I said. I said that that's one piece of the puzzle. And we'll talk about that in just a bit. But anyway, looking at price action, the one thing I can get looking at price action is momentum. And when you start talking about calling something over the next, few months to a year or even longer, you need to be looking at weekly or monthly charts. You can't be looking at daily charts or hourly charts. You can't call the long term or even the intermediate term by looking at an hourly chart or a 10-minute chart or a 1-minute chart. That's you're comparing apples and oranges. You need to step back, take a look at the bigger picture. And I think that starts with probably the weekly chart. I mean, the daily might start to give me some signals, but I'm going to want to back out to the weekly, maybe even the monthly, to get a little bit better idea of what's taking place. So, and if we do that, here is, the S&P 500. What you can see back at the end of 2021 is we were going up to the high. We did see the weekly PPO dropping, negative divergence. Same thing, beginning of 2025, we were going up. We had lower PPO, negative divergence, telling us that the long-term momentum is starting to slow. Now, does that mean that we're going into a bear market because I'm looking at this one chart and I got these pretty pink lines on it? No, has nothing. It's not just one signal. You're not going to look at one signal, but this is going to be something that's going to, in my mind, I'm going to know, hey, I got negative divergence on a weekly chart. That's something to be aware of. Now you can step this out and we could go take a look at it, say a monthly chart. And on a monthly chart, we came down to the center line back here after the 2022 bear market. And since then, we've been going up. And every pullback, we've been bouncing off the rising 20-month moving average. That's exactly what I expect. Now, some people look at this and say, whoa, no, we still have a negative divergence. Well, I mean, if you're going to follow that, let me show you this chart. I mean, if you want to be literal, let's go back to 1999. I mean, you would never get back in the market because we've had lower PPOs ever since 1990. Actually, 1998 was when we topped. So you'd still have a negative divergence every time you set a new high until you take out, that high PPO there. But that came on the heels of one of the biggest 3-4 year runs in stock market history. To get the PPO back there, we might not ever see the PPO back there. So you can't do that. Once momentum has kind of shifted and, it's played out. And I always talk about a PPO reset when you get down to or near the zero line, because at that point you have no momentum. The PPO is the difference between a short-term exponential moving average and a longer term. I mean, the default is 12 and 26. So you're looking at a 12-month exponential moving average and a 26-month exponential moving average. Once you go through, a lengthy period of weakness, they're going to start to come back in line together. You're going to get them very close to zero. And then when you start moving back up, usually it's just the pullbacks you're looking to the rising 20-month moving exponential moving average, which is what we did. We bounced off of it, printed a hammer. And as far as I'm concerned, this cyclical bear market's behind us. I mean, if you want to keep trading it, that's up to you. But based on everything I'm seeing, money's pouring back into aggressive areas of the market. And that's kind of what I've said since the bottom, is that money is starting to rotate back into, in more bullish fashion. We had crazy manipulation by market makers, in my opinion. Lots of gap downs followed by intraday buying. Gap down, intraday buying. Gap down, intraday buying. I mean, we saw that for a period of time down near the lows, and that's how Wall Street gets all the shares they need before the market starts going up, because the individual traders like you and me, if we're following CNBC, we're panicking because of all the bad news that's being shared. And of course, then throw in the politics and stagflation and, oh my gosh, this is going to be horrible. Meanwhile, the S&P 500's getting pretty darn close to another all-time high. And I think in 2025, we're going to see all-time highs again. So that's one part. That's just one piece. One secondary indicator calling the market is looking at divergences. Here, actually, I went a little bit too far there. I went ahead of myself. Let's go back over here. Let's look at the XLY, XLP, consumer discretionary versus consumer staples. Here you can see the big move up in the XLY, XLP. Here's the S&P 500. Notice that they kind of go somewhat together. Down below here is a correlation coefficient. And what this tells me, and it tracks, what I'm doing is I'm tracking the correlation between the direction of the S&P 500 and the direction of the XLY, XLP ratio, how they're trading versus one another. I'm using the direction of both. And when you're above 0.5, like in this blue shaded area, that's telling you you've got very strong positive correlation, telling us that the XLY, XLP ratio historically goes kind of in hand with the S&P 500. It's really important to understand that. And it makes perfect common sense, because discretionary is more aggressive, staples are more defensive, and consumer spending is 2/3 of our GDP. So we want to follow what's going on in consumer stocks and how they relate to one another, because if things start to shift and we start seeing more things, more money rotate toward defensive areas, that starts to reek a little bit more of a warning sign. And when the XLY is taking off versus the XLP, that's generally a very good sign. And so you can see that we're holding this prior low. We're bouncing right now. The XLY, XLP is doing very well. And that generally means the market goes up. And guess what? Market's going up. So another very important signal to watch. Then we've got growth versus value. So I want to show you the 2022 cyclical bear market before it started. Started right from here. Remember? Beginning of the year, 2022, January. Here's the S&P 500. And from November all the way through the beginning of January of 2022, S&P 500 went to a new high. Take a look at some of these ratios. First, discretionary versus staples. Money is rotating away from discretionary and into staples. Caution sign, you should be seeing it. Technology relative to the S&P 500 had been great. It topped in December. And as we made that new high in January, we did it without the support of technology. Look at technology starting to collapse at the beginning of January while the market's setting its final all-time high. How about Russell 1000 growth versus Russell 1000 value? Growth versus value ETFs. IWF versus the IWD. End of November, we top. Going into January, growth is starting to underperform. Beginning of January, it completely collapses. Doesn't this, if you're looking at the market, aren't you going to be a little concerned if money is rotating away from growth stocks while you're setting a new high? I mean, I can promise you CNBC wasn't talking about it. They were cheerleading, a new market high. That's what, and of course, that's exactly what the big Wall Street firms that pay CNBC so much money to be on there, that's exactly what they want you to think. They want you to think everything's perfect. Keep buying, NVIDIA, keep buying Apple, and keep buying all these growth stocks. And while you're doing that, we can sell to you. And we can start moving into more defensive areas that you don't want any part of. And then the shoe drops. And then the bear market begins. That's how the top formed in 2022. You want me to show you how it topped just recently? I mean, might as well put it on, rinse and repeat, because that's what happened. S&P 500 in December tops. Going into February, S&P's going higher. Perfect. Discretionary topped in January relative to staples, starting to come down. And by the time we reach this top, look at where we were on this ratio. February 19th, we were at about a 2.5-month low on the discretionary versus staples. Wall Street's rotating out of it. Market's going higher. How about the other? How about technology? Well, we topped in technology back at the beginning in January. And when we topped in February in the market, we were well below the top previously. And then look what happened as February wore on. Big drop. How about growth versus value? Topped back in December. Money rotating away from growth. So you got money rotating away from discretionary, from technology, from growth, all at the beginning of the year. And of course, there were a lot of other signals as well, but these I just wanted to focus on because I like to see this rotation at tops. Sometimes you see it at bottoms. I think tops are easier to spot in the overall market. Well, actually, I shouldn't say that because I think bottoms are pretty easy, but you have to shift to sentiment. It's not always these same charts. Sentiment will help you call bottoms in the market. And I'll show you a little bit about that in just a bit. But anyway, yeah, there's your 2025 bear market right before we started. It was an exact replica of what we saw at the end of 2021 into early 2022. So it's not that difficult to spot things that are not looking right in the market. But if you listen to CNBC, they're not going to come on here and tell you all this. Why would they? How are they going to get out? They got big money. They got to get out. They don't care if you get out. They just have to get out before you. Volatility. So this is sentiment. Couple things that I like to look at. Anytime sentiment, the VIX goes above 20, be careful. That doesn't mean every time it goes above 20, we're going to have a collapsing market. It just tells you that fear is starting to ramp up and bad things can happen when fear starts to escalate. Here, it went above 20. This is a daily chart. So it went above 20 beginning or end of July. And 1 or 2 days later, you can see it was actually, we'd already gone down a lot, but we went down a lot more, another 150 points. Here, we broke out above 20. We saw a little bit of a dip after that. Here, not so much. Here was pretty much just flat. Same here. Here, we actually went above 20. You can see pretty significant decline. And then more recently, at the end of March, is when the VIX shot up above 20. And from that time through April, you can see, and this is really what you want to try to avoid. I mean, we were at 5,600 and we got down to 48.35. That was 800 points in about a week, a little over a week. So again, when the VIX gets through 20, especially if it keeps going, when it gets into the 30s, the 40s, it makes it very, very difficult. And you have no choice almost. If you're following anything in the news, this is all they're talking about. S&P 500 futures down 4%. Next day, S&P futures down another 3%, down another 5%. And so the market's just getting killed by these opening gaps. And then all of a sudden, we see these buyers come in after the morning hours. Wonder who that could be. Wall Street, same people that were getting out the top and weren't telling you, are getting out the bottom and they're not telling, or getting in at the bottom and they're not telling you. How did I find that out? Using, sentiment number one, but also manipulation. Back in June of 2022, same thing. I was looking for when the market was just going down by gaps. It was only the gaps. That's the only reason we were going down. Earlier, during bear market, actual movements to the downside, we'd go through a distribution phase where we were going down all day long throughout the trading day. You get down to the bottoms form by getting these big gap downs because we're already seeing a lot of selling. There's already a lot of fear in the market. And these big gap downs are what creates the panic among retail traders. And so they're just getting out, never want to touch the stock market again. And, at that point, they think the absolute worst of the market, which is great if you happen to get out at the top, because now it's time to get back in. And we saw this perfectly in April. Next one. So once we're in a bear market, so I've kind of highlighted these bear markets in 2000, 2007, 2018. That was the trade war. 2020, the pandemic. 2022, rising inflation, and then of course the Fed started raising rates. Interestingly enough, by the time they had their first big hike in rates, which was in May, I remember folks telling me, "Oh, market's going to get killed. The Fed's just starting to raise rates. Rates are going to go up." That's all already built in. The market looks ahead. So the first time that we got a big move up in interest rates was in May. We went up 50 basis points. And June, I was calling the bottom. And everybody thought I was nuts. I mean, go back and look on YouTube and just say, "I'm calling the bottom" with my name, and it'll come up. And just look through the comments. I would say probably at least 80% of them thought I was absolutely nuts. And yet, turned out to be a pretty darn good call. But it's following these signals. At the bottom, sentiment, manipulation. At the top, all these different topping signals that I like to follow. Anyway, here's the last one we just went through here at the beginning of 2025. The thing I wanted to point out is that we don't confirm that the bear market is over until the fear subsides enough. And the fear is, you can kind of tell the fear by the level of the volatility index, the VIX. And so historically, the bear market, you can't really call the end. Once we dip back down, I've got this line coming across here for the VIX, this horizontal line, and it's at 16. And once you've gone below 16, we've never gone back down. So like here, in this move up, this became a cyclical bear market right here before we had another cyclical bull market, before we had another piece of the secular bear. But during this cyclical bull market, we saw the VIX go back down below 16. So this bear market was over, and we were trending back up. We went all the way back to the high. This one, once we came back up above 20 and started this second part of the secular bear market, notice the VIX, even during this rally back here in the middle part of 2008, the VIX came down to 16. That was it. Stopped, turned around, and went right back up. Soared as we collapsed. You go here. Once we went up, came back down through 16. It was over. We went back to new highs. Here was the pandemic. We shot up into the 60s, 70s, whatever. We might even been higher than that intraday. But then when we came back down, went below 16. At that point, we were done with the bear market. Here we got 2022. VIX stays above 16. Once it went below 16 in 2023, we hadn't broken out to an all-time high, but we went below 16. Fear was gone. or it was just not enough fear to carry a bear market further to the downside. And so once we went below 16, we went back up to an all-time high. And now here we are in a bear market, and the VIX is not yet confirmed that we are out of this bear market. So from this confirmation perspective, we have to kind of hold off. I mean, like I said, we saw signals at the bottom and said, hey, let's get in. But the VIX hasn't yet confirmed that we're going back to all-time highs. We did get back down to 1724, which from 55.60, which is intraday where we got up to, getting back down to 1724 is pretty awesome. All right, I got one more chart, and then we'll move on. The next couple segments should go pretty quickly. I mean, I'm hoping that we'll be done, 11:30 probably at the latest. So we still got, some good stuff. You're going to want to see, what we got coming up, but I just want to give you some idea if you're wondering how long it'll last. So the last chart I wanted to show you was this sentiment chart. And I talked about this recently when it just came out in April. Market was going down. Everybody thinks we're in a bear market, blah, blah, blah. And at the beginning of April, we came down and the University of Michigan consumer sentiment was reported at 50 and change, like 50.5. And then it came out 2 weeks later, and I think it adjusted it up to 52 52 which is where we are right now. But look at this chart. And I just want to point out that if you bought when the University of Michigan consumer sentiment bottomed below 65, now this is assuming you catch the bottom, but honestly, you could get in anytime it hits 65, and I think you'll be fine in the market. But you have to understand, when everybody's feeling the worst, the market's been priced. It's already been priced in. Stock market looks ahead. It's not waiting for consumers to feel bad to go down. Market goes down. That's what causes consumers to feel bad. So once you've got consumer sentiment down in the lower end of this range, look at where these arrows mark the bottoms or the lows. And then, there's one down there. So look at all those green arrows. And I put them in green because it's time to be long. Market's going to go up. And look at where all of these arrows come in. And tell me, would you have wanted to buy at those points? Hopefully you'd say yes. Now, contrasting the really high consumer sentiment, the highest level we ever hit was above 110, and it hit at the top of the market in 2000, right at the end of the secular bull market. Now think about if you waited until consumer sentiment was off the charts to the upside, and you're like, okay, now it's safe to get in. Look at what you would have gotten into. You would have waited 13 years to make money on your money, or to make money on your investment. 13 years. You don't want euphoria. You don't want consumers euphoric. That was the reason that one of the biggest reasons why we topped in 2021 or early 2022 was all the bullish sentiment. I mean, the equity only put call ratio was the lowest by far that it had ever been, meaning that there were a lot of folks that's just pouring into calls thinking the market was going to go up right here. And then the market went down. So sentiment is a contrarian indicator. It's telling us, it's looking in the rear view mirror. It's not telling us where we're going. It's telling us where we've been. So this was one of the things I pointed out just a few weeks ago, maybe 5 weeks ago, probably first or second week of April when that consumer sentiment report first came out. And I said, this is a bullish sign. This is when you want to buy, not when you want to sell. And then again, back to the upside. So anyway, that's, again, I could spend 3, 4, 5 hours on guidance and calling the market. There's so much out there to talk about, but these are some of the highlights I just want to give you so that you can start to feel like, again, when you're building a winning portfolio, you have to first start out with, do I think the market's going up or do I think the market's going down? That's where all this comes into play to start the process of building a portfolio. You can't just say, I'm just going to jump in. What if the market looks like it's topping? You don't want to just jump in. So anyhow, that's where we are. John, before we go into the next segment, do you want to talk about something? You want me to pull something up on the screen, or do you want to take the screen?
No, yeah, that would be great. Number one, terrific presentation so far. I'm taking notes. I've been working with Tom for, I don't know, 35, 40 years. I learn something every time. I do want to say, if you like what you're seeing, hit that like button and subscribe to our channel. That really helps a lot. We're building our community. I do want to take just a minute, because every time we have one of these events, we want to reward people who took the time to come in. We have what we call our flash sale. Now, this flash sale really is as good as it's going to get. Normally, an annual membership is $9.97. If you sign up for the flash sale, which ends, I think, Monday night, you're going to save $300. So it becomes $6.97. And I'll have a little bonus for you in a second. But let me tell you what this gets you. Number one, it's going to get you into Tom's Monday top 10 stock picks. All the things he's been talking about earlier in the performance. His new batch of stocks for this next quarter is coming up Monday. So if you want to be involved in that, take advantage of this flash sale. Second thing, Tom puts out a weekly market report every Monday, very extensive, and gets you all prepared for the trading week. And that's followed by a daily market report where if anything changes, Tom's going to let you know. It also gives you access to all the chart. We have some tremendous chart lists that Tom and Matt have put together that we just get a lot of praise about. And last couple things. Every quarter, so the next one I believe will be July 1st. Yeah, we will have a quarterly market update. Tom does a tremendous quarterly market update to get people prepared for what to think about in the following quarter. And it culminates with our grand event of the year, which is what we call our Market Vision. Started that in Market Vision in 2020 and had it every year since then. And that happens right at the beginning of January, and it gets people set up for the year. And Tom has made some tremendous calls to get people set. Anyways, you can go right to our website, and you'll see at the top it says Flash Sale. Click on it. Just do it. You'll save a lot of money, and you'll have access to events like you're seeing now throughout the year. Remember, this goes through Monday, but I will offer one other thing. If you sign up for this today by midnight, I will give you another bonus month. So you have $300 savings. You get another month. You have 13 months. It doesn't get any better than that. So really, if you like what you see, you want Tom on your team. And I don't have time to go through all the testimonials that we get from people on a regular basis, saying how much they appreciate Earnings Beats and Tom. And I'll land on saying that we have a true commitment to service. Matt really keeps on top of everything for our members. We make sure that we back up what we say with our actions. So anyways, go to the website, flash sale, do it by tonight, midnight. You get an extra bonus month, so 13 months. And Tom, I'll end it on that.
Yeah, sounds good. Yeah, this is a really good deal. Again, if you've been following us for a long time, we've got a lot of members that are very, very happy. Talked a lot back in January and February about, I said I was 100% cash. Pointed out to all our members, I got out of everything. It was a little bit early. That's okay. Tops, are going to take some time to form. Be nice to hit it exactly on the top the right day, but there were just a lot of warning signs. They weren't going away. I showed you exactly what I was talking about in terms of rotation. I mean, that stuff doesn't lie. And there's a lot more to it. I'm giving you, some of the snippets of things that I looked at that I thought were really important in calling some of the tops and bottoms and so forth. But there's a lot that goes into it. We continually do independent research. I think that might be the most valuable part of our service. We don't take anybody's word for anything. We're not just regurgitating something we saw on social media. Never going to see us do that. I don't like pointing something out unless I know that it's factual. My background, I was in public accounting for 20 years. Ethically speaking, public accounting. Most public accountants are going to be pretty high in terms of integrity and ethics and so forth. And I kind of carried that over into the stock market. I know, our service competes with a lot of other companies that maybe aren't top of the line. Maybe ethics isn't number one, but it is in our case. I think, again, I think our history proves itself. And as John said, we do have a tremendous number of testimonials and so forth over the years. Members that have been with us since the start. I mean, we've been doing this now for over 20 years. It's not like we just started this, last 2, 4, 6 years. We've been around a long time. We've been through multiple bear markets. I think we've got a really good history of calling them before they happen. So at least consider taking us up on this offer, because it doesn't get any better than this. I mean, this is a very, very, very good offer. I know we've had some members or some followers who have said, well, I just can't afford you. I really, love the work you do and everything. We try to do these flash sales to try to make it as, as affordable as we possibly can for folks coming in. The other thing I'll say too is that we've added a lot of services over the years, and we have rarely raised prices. I can't even remember the last time we had a price raise. While everybody else has been raising with inflation and everything, we haven't had a price increase. And many times through these sales, members actually a lot of times get their renewals cheaper than they got in originally. So anyhow, take us up on this offer. You won't regret it. Give us a year, and I think we'll prove ourselves, and we'll prove we're worth every penny you pay. All right, let's keep moving on here because we still got a bunch to get through. I want to start off talking a little bit about our top-down approach. So again, I'm going to try and finish all this in 30 minutes, maybe a little less, to give some time for some questions. So I'm going to try and go through all this pretty quickly. But the first thing I do when I'm looking at the market is I want to know what's leading the market. I want, in a perfect world, I want leading stocks. I want my portfolio filled with leading stocks and leading industry groups. I want stocks that are not just doing well, but doing better than their peers. And I want the entire group as a whole, if I can, to see it outperforming the S&P 500. Now, I did a YouTube show, one of my stock chart shows, and I do stock chart shows. I do earnings beat shows. I mean, follow me all over YouTube. Just type my name in. You'll see plenty of videos and so forth. But I probably do 1, 2. I do at least 2 videos a week on YouTube. We also have a live trading room every Wednesday. So anybody signing up, you're going to get that 4 times a month for the next 12 months. So you're going to get 48 of those. And they tend to go on way longer than they should, because I don't know how to stop talking. But there's a lot of education built into those events as well. It's not just, hey, buy this, sell that. To me, I'm not a registered investment advisor. I don't really want to spend my time saying, hey, guys, everybody or gals, buy this, sell that. I point out what I like, and I tell you why I like it. And I'll tell you why I think the target's X and why I think the stop should be X. But I don't say buy this, buy that. That is crossing the line from educator to, in my opinion, advisor. And so I don't like words like recommendations or, buy, that sort of thing. It's more of a, just showing a scenario. But anyhow, looking at the sectors. So we've got 2 chart lists at Earnings Beats that we share with our members, annual members, which you would become under that flash sale, by the way. But one of them is the sectors relative to the S&P 500. So you can always, at all times, go back and look to see how each sector is performing relative to the S&P 500. So here is technology. This, like I said, we topped. Well, I mean, we were going down January into February, and even the move up throughout the fourth quarter. I mean, look at technology. It peaked back in June, July of last year. And most of that was because that's when semiconductors had peaked, and semiconductors are a big part of technology. But you have to understand all of that in making calls about the market. So we started including fewer semiconductor stocks when semiconductors and when technology started to move down. You still want to include some technology stocks, some leading technology stocks, because technology is usually about 32% of the S&P 500, in that range. So if you want to beat the S&P 500, it usually helps to have technology stocks that are beating the S&P 500. But it's just harder to find them when the entire group is not, performing as well as the S&P 500 when it's going down. That's what this is telling us. That's where we went down. Look at the bottom, right? April 7th. Look at this move back up. We're all the way back up here to the highs over the course of the last, 7-8 months. We're getting very close to breaking out before the S&P 500 hits a record, by the way. So we're seeing that money rotating back. You need to understand that that is a good thing for the market. That's a bullish development. All these people talking about stagflation. You know what would happen to technology stocks in a stagflationary environment? These stocks would be getting killed. So why is Wall Street moving back into these stocks? Why is stagflation out there? Why are, some of these Wall Street firms, parading their analysts, or as I like to call them, influencers? Why are they out peddling and talking about the possibility of stagflation? That's not what they're buying. That's not what's going on in the charts. That's why I follow the charts and I don't follow the lips. The lips are never going to tell you what's going on. The charts will always tell you. This is the money. This is where the money's going. They're not going to try to fake us out by buying things that are going to go down. They don't want to lose money. And when I say they, I'm talking about Wall Street, the big Wall Street firms. When this starts turning like this isn't because you and me are buying technology stocks. This is because the Wall Street firms are loading up on technology. So there's first sector. Now we can go down, we can take a look at discretionary. Discretionary bottomed in March. Stock market bottomed. Well, there's the actual price went down and bottomed in early April, but the relative strength had already turned. So discretionary was going down, but it was going down less than the S&P 500. In other words, money was starting to rotate, and that's what this shows us. The relative chart is showing us that discretionary now is at a go back here, about a 3-month relative high versus staples and versus the S&P 500. Communication services. These are the 3 aggressive areas of the market. Communication services never really went down, just kind of been sideways for the last 3 months. But these are the 3 areas that contain a lot of those growth stocks that drive the market, that drive secular bull markets to the upside. Technology right now is flying. Discretionary is outperforming. And we're seeing maybe just a tad underperformance right now in the communication services area. I mean, these are the aggressive areas of the market, and they're performing well. So if you want to translate that into being something like, oh, the market's going to go down, that's completely up to you. I don't believe that's the case. Now, look at the defensive groups. These last bottom, or these 4 right here: healthcare, staples, real estate, and utilities. So here's healthcare. Since April 7th, everybody's back getting out of healthcare. It set a new 52-week low. So getting out of healthcare. Staples were running up until about the 3rd week in April, and it's just fallen apart. Staples are coming down while discretionary is going up. Very bullish development. Then you've got real estate. Look at real estate, another defensive group under a lot of pressure since that April 7th. That's when they were outperforming, is during the period when the market was going down. Money was rotating into defense. Now money's doing the exact opposite. It's coming out of defense, going back into offense, which is what you want to see on a big secular bull market rally, which is what I think we're seeing right now. And then the last one is utilities. Utilities were strong until the middle of April, and now they're moving back down. So again, you've got aggressive groups moving up relative strength, defensive groups moving down. So if you're going to put a portfolio together, looking for leading stocks and leading industry groups, where are you going to focus? For me, it's going to be the aggressive areas. Now let's move on to the industry group relative strength chart list. And so there's like 104 charts in this list where you can look at every single one. This is weekly instead of daily. But you can see which groups have been performing well. Some groups like computer services just kind of go up and down. They never really, it's kind of hard to get a good sense of what their true, have they topped? Are they starting to come down? Or is this a bottom? They're starting to go up. I mean, it's hard to say because they have such a checkered past. But 2 weeks ago, or maybe 3 weeks ago, on one of my stock charts YouTube shows, I said, and it was something about, watch these bullish momentum, or these areas that are showing momentum, something like that was the title. And it was just a few weeks ago, but I brought up 12 industry groups, and one bonus, I think. Let me see, that's 11 industry groups. And then I threw in one more to make it a dozen. And let me show you those groups and what they're doing right now in terms of relative strength. And again, now this was a few weeks ago when I talked about this. So, whoops, looking at the wrong. Let's look down here. First one is software. So software, look at what's happening on a relative basis. Just all of a sudden over this last 6-7 weeks, all of a sudden we took out that high. So we had a series of lower lows, lower highs. Not anymore. We've actually taken out that prior lower high. So now, in my opinion, we've got an uptrend going on. We got a golden cross on the 20-week EMA. It's a relative EMA crossing over the 50. So we've got a kind of a relative golden cross, if you will. So software leading to the upside. I would certainly be thinking about some software in my portfolio. Let's take a look at another one, which is electronic equipment. Look at this move. Been straight up for the last 6 weeks or so. Just crossing back over the relative PPO, just starting to turn positive again. This one's been a little choppy, but there could be an individual stock within electronic equipment that's really starting to perform well, and that would be what I'd be looking for. Another one would be electrical components and equipment. Kind of similar to what we just looked at with the electronic equipment, but big move up over the last 7 weeks or so. You can see here's the absolute move on the electrical components area, and just crossing over the center line again. So this is a group that's been on fire, continues to show a lot of strength. These, again, if you're trading or investing short term, I think you really want to pay attention to what's leading the market and stick with those areas. Next up, let's move on to discretionary. How about specialized consumer services? What a huge move back in March on a relative basis, and it's kind of holding its own up here. Look at on the absolute chart, double top breakout. I mean, it's breaking out on an absolute chart. It broke out on a relative chart. Again, that's kind of what we want to look for. Specialty retail. I mean, this has been good now since July of last year. Just strengthening, continuing to strengthen. So a lot of the specialty retailers doing well, which probably doesn't make a lot of sense with stagflation coming up, right? I mean, I've even heard Fed officials talking about stagflation, and they're throwing it out there as a possibility, which, okay, why not throw out as a possibility that inflation's not going to move up and that you're going to start cutting rates, and where the S&P 500 might go if that's the case, because that's the way the market's trading. Anyway, I'll go way over my time if I get started on the Fed. Next up, travel and tourism. Look at this chart. Relative basis just made a new new 3-year high and broke out on an absolute basis. Travel and tourism looks good. See stocks like Booking Holdings, which is doing well. Expedia bounced back, but it hasn't been doing as well as Booking. Airbnb bouncing back. But anyway, in that area, you got stocks. How about heavy construction? Which is, let me find it. Here we go. Heavy construction. This is in the industrials. Look at this move on a relative basis for the past couple of months. Heavy construction has been very strong. I mean, it's been almost straight up relative to the S&P. This doesn't mean it's going up. It means it's going up faster than the S&P 500. Or when the S&P was going down, it was going down, but at a lesser pace. So it was actually outperforming even though it was going down, like right here. See how we went from this low to this low? But here we went from this low to a higher low. So it was still going down, but I mean, you can see this was all the way over about here. I mean, we were going up in terms of relative strength, but we were going down in terms of price. That's that rotation taking place at the bottom. Aerospace, another group, been on fire. I mean, look at this, just massive move here in 2025, breaking out on an absolute basis. A lot of stocks in the aerospace. I wouldn't be surprised to see maybe one or two in our portfolio come Monday. Consumer finance, moving on to the financial area. How about consumer finance? Great area relative to the S&P 500. It's been great for the last 10 months and breaking out on an absolute basis to a new all-time high. Investment services. There you go. Full year of outperformance in investment services. How about full line insurance? Just all of a sudden, out of the blue in February, huge move up to the upside and moving to an all-time high. And then the last one I've mentioned, this is a little wild card I threw out there 2 or 3 weeks ago. And I said, you know what? I said, this is one of the most important areas of the market, if not the most important area of the market. And I had told members, I think I was looking maybe on a daily chart on relative strength, but I was looking at 3.07. If we could get through 3.07 relative to the S&P 500, we went through 307 and we just took off to 332. So what it's showing is just that semiconductors are really pushing this move in the S&P 500 to the upside. And you don't want to mess around with semiconductors when they are on a roll. When they go, and it's usually very swift. You can make a lot of money. I mean, if you've been watching NVIDIA or many of these other, I mean, AMD, some of the other semiconductors, I mean, KLAC, ARM started to make a move recently. Anyhow, when they start moving, and some of the smaller ones, they've had some smaller ones that have really, really taken off. I think like SITM was showing a lot of strength. There was another one. I can't remember the name, but anyway, there's a lot of semiconductors. You can go and look at that group. But there's a good chance semiconductors are going to be well represented in the portfolio come Monday because of that relative strength that we have. All right. Another thing that I like to look at seasonality. So what I'll do, for instance, is I'll type in something like the XLK, just look at technology. And I also want to look at it relative to the S&P 500. So this is relative seasonality. How does technology perform relative to the S&P 500 throughout the year? And so when we first do this, it's going to show us the default, which is just the last 5 years. But you can drag this back to, say, 13 years, which takes us back to 2013, which is when this secular bull market began. And look at May, June, a little bit of outperformance, but look at May, June, July, and August, these next 3 months. This is going to be when the portfolio's out. Starts May 19th and it ends August 19th. Well, I'm looking at 3 of these 4 months being the best of the year for technology stocks. And I don't know, I'm going to just go in here and put in the semiconductor group and just see if we go back 13 years. The outperformance is so actually May, a lot of outperformance. June, July, and August, slight outperformance. So I'm not sure. I'd have to go back and take a look. We do a monthly seasonality report, though, and June will be coming up in a couple of weeks. But, I'll be taking a look at this to see which areas up within technology tend to perform really well in over the course of the next 3 months. And that will have a little bit of input as far as what I like as well. So if I know that an area of the market tends to do really well, I mean, look at May, 92% of the last 13. So it's probably only been one time, like 12 of the last 13 years. May has been higher for semiconductors. One big reason is that NVIDIA loves its earnings months, February, May, August, and November. And NVIDIA's had a huge pre-earnings run up. And I talked about this before it ever started. NVIDIA loves the month of May. And so it's carried a lot of semiconductors up. And so we'll kind of see, but that will probably be a part of our portfolios. And I mean, I'll go through all the different sectors. I'll pull up one more just to kind of, let me see, let's see what I don't even know what the XLY looks like over the next few months. But over the last 13 years, June has been the best month, 75%. So over the last well, actually, it's only 12 because we haven't had June this year yet. So it's only 12 years. So 75% of them are nine of the last 12 years. Discretionary has outperformed the S&P 500 in June, and almost 60% of the time in July. So if we just look at the last 12 years, there. So 58%, I'm guessing that is going to be 7 out of 12 years. So, I mean, the odds are with us with discretionary. Look at in terms of the average outperformance by month. If you look across the bottom here, I'll kind of make this a little bigger so you can see it a little better on your screen maybe. But this is where we start. Come across June, July, both 1% or more. September's 1%, November's 1.1. So these are literally two of the best months of the year, June and July. So discretionary, we're going to want to have, really good representation of discretionary stocks. I mean, these are all the things I'm thinking about in building the portfolio long before I've even looked at a stock. I'm looking at the overall market. I'm looking at sectors, industry groups. And so by the time I get to the stocks on the strong earnings chart list, I'm going to be zeroed in on some of the areas that I'm really going to want to focus on. So a lot of my portfolio and my thinking behind it's already been done before I look at a single stock. Yeah, and then from here you go in and we look for leading stocks. So one way to do that, let me just pull up the S&P and then find the chart list here. So we pull up the strong earnings chart list. I told you we'd pull it up and talk about it a little bit more. And I'm going to view as summary chart list. So we're going to go back to that. Well, actually, the edit is where we were. That shows you the charts, the 545 charts that are in here. But let's go back to that summary page. And the summary page, we can pull up the columns, sector and industry. So it kind of tells us there. I also want to pull up the Scooter, which is Stock Charts Technical Rank. It's a relative strength kind of an indicator. And then if I really want to go into, say, aerospace, and I don't even know how many aerospace companies are on here. Maybe they only have one or two. Maybe none. I don't know. There's aerospace. Actually, we have 6 of them. And I can order this in Scooter to get an idea. Now here, the same stock's on here twice. You might say, well, why would it be on there twice? Well, look at the numbers. So apparently they didn't report exactly 3 months apart. They probably reported like 2.5 months apart. And so I hadn't removed this ATRO when the new one came out. So they actually beat the last 2 quarters. And this is a company with a Scooter score right now, 96. You got Boeing at 96, ERJ at 85. As you get further and further down the Scooter line, the less likely I am to pull it up. But it's possible, like a CAE has been consolidating. I know that because it's in our portfolio right now. It's in one of our portfolios. Here's CAE. Took a big hit back in April along with everything else. But look at how quickly it came back, almost got to an all-time high, or at least 52-week high. Pulled back with earnings, and now it's coming back up again. So we've had a nice rally back up. Look at the AD line, accumulation distribution. I say Wall Street's still pouring into it. This is a stock that might make it in another. Well, I don't like this because it's come down to about a 6-7 month low relative to its aerospace peers, which, can be a period of consolidation, but 7 months is a long time. So that might be one that maybe I'm not overly excited about, but let's take a look at this ATRO. I mean, this is probably a little bit smaller company. Yeah, volume. I mean, the volume average is probably enough to put it out as a portfolio stock. We really want to make sure that the liquidity is strong on any portfolio stocks. But yeah, I mean, just look at the last run up that we've seen in the past month. I mean, this is just a crazy move to the upside. And there's your AD line, new high. And here's your relative strength, new 52-week high relative to the peer group. And here's the leading industry group, we talked about aerospace versus the S&P. So you can just quickly see it's a leading stock in its area, and the group is leading versus the S&P 500. Great volume trends. Now, would I rather, and this is the beauty of not exactly following the model portfolio strategy, because if we decide to get in, we're getting in whatever the price is. We're not going to wait on a pullback. And you might say, well, that's dumb. It's overbought. It's going to pull back. Well, if you can time it better, then go back to this very first, where was it? No, I don't have it up here anymore. Sorry. But that chart where we outperformed by so much, that's using the same, thing that we've been talking about. I mean, sorry, get back to this right chart. We were buying on the 19th, and if they were overbought, they're overbought. We put 10 equal weighted stocks in there, and we've still outperformed by a mile. So if you take the stocks and you can find better entries into them, your performance will be even better than what we've had in the model portfolio over the last 6 years. So, I think the strategy's proven. This is the way we go about top down to try to find different stocks. And then it comes, and then timing entry, which is literally, the last thing that I really wanted to talk about is, individuals, all of our members, even though we might go in when stocks are overbought, you have the ability actually, if you're following these companies, to wait and see if you get a pullback. If you're uncomfortable, no, I'm not going to push your hand. I'm not putting your finger on the buy button. Again, we're not registered investment advisors. I don't care whether you buy these stocks or not. It's completely up to you. You can do it in whatever fashion you want. You can ignore all of them, and do it your own way based on some other strategy that you like. That's fine. But I wanted to explain how we do it at Earnings Beats. So that's essentially, what I have now. One thing I'll mention before we take questions is that on the strong earnings chart list, you'll notice that you're going to see, now this was probably the older one, the ATRO. I probably clicked on the one that was highlighting support back when this earnings report came out. They probably see, it looks like earnings here came out 2 months apart, which is a little unusual. And that's why, again, we have this stock on this list twice, because based on where it shows up chronologically on our list, we would be removing this stock as we get closer to the end of May and early June, because normally we would be expecting it to report in early June. So we take it off. If they report great, you put them back on. In this case, they were still on. I hadn't removed them because when they reported, it was 2 months later. It wasn't getting close to 3 months. And again, that's when I take them off. So if I go into the next one, the second one, and pull it up, it'll be a different chart. And now you can see I'm using the gap support as a key support level. I mean, and I do it at the time of earnings. So as the stock keeps going up, I could clearly raise levels. I mean, it's only so much time in a day. We got 500 companies here. I can't keep going back and adjusting the level. So it's done at the time earnings are out and they get added to the report. But then, now you got a gap support in here between about 27.5, 28.5. That could be the next area, because now the 20-day has gone up above this price or gap support level at around 25.30. So you can continue, but even pulling back to 28.5 from here. Let's say we get in this Monday and it's at 30, and then the stock does pull back, gets back down maybe to 27.5, 28, and you're like, okay, I'll get in here. Well, you're going to do a lot better than we did, at least with this stock, because you're going to get in at 6-7% cheaper. So all of these stocks, as we go through here, and I'll just flip and just randomly pull up one. I don't know. Let's PINC. So there was the big gap up, move up. Here was kind of the line. The 20-day, anytime you're in an uptrend, I think the 20-day moving average is a good support level. I don't annotate it because it's just in an uptrending chart. Anybody who's followed me knows I love the 20-day moving average as an entry point. So as this keeps climbing, we might, fail at this top, come back down, put in a second bottom here at 22.25. And that might be just when the 20 days getting up to 22.25. And you might look at that and say, hey, this is a good time for entry. But we do this for every stock, 550 stocks or whatever that's in here. Every one of them are annotated with 1 or 2 key levels of support. Again, I'm going to flip up here. Boom, just grab one. So here, this was earnings. It went up. And then look, 2 days later, it came right back down, tested that gap support. And then boom, back off to the races. Let's see, another one. Oh, Duolingo. I tell you, you might see this one on the list come Monday. I really like what happened here. Big gap up. Look at the volume. I pay attention to volume too. When you get the volume that comes in, it's almost the heaviest of the year, 3rd highest volume of the year, and it opens up. Normally, you get gap fills. I'm pointing out a lot of these stocks where I'm showing gap support at the top of the gap. Sometimes I don't even show the bottom of the gap because if a stock comes in, normally market makers are on the other side of that. So when the market gaps it up because of solid earnings, market makers are usually shorting at the opening bell. In this case, the stock kept going up all day long, which tells me even with market makers taking the other side of the trade, there was so much demand in this stock that it just kept going higher. And market makers very likely had to cover their positions. They don't make money on every trade. They got overwhelmed here by demand. And now you can see, it just kept going up, up, up. Now it started to roll over. Maybe we'll see a 20-day test. Maybe we'll even, see it back at 440. So if we get in on Monday, again, we might get in and, maybe we're lucky enough on Monday, it pulls back a little bit further and we can get in somewhere between 500 and 520. It might be a situation where 465, 470, or even 440 could be a better entry down the road. But, you've got these annotated charts to follow as well. So I wanted to mention that as far as trying to time your entry. I give you, and I literally, when I look at these charts after earnings, obviously I can't take 10 minutes to annotate each chart, or I would, take 500 and some charts times 10 minutes and do the math. I don't have time for that. But I've been looking at charts for so long, I pull this up and I can, within seconds, I just look at it, the volume, and I know a lot of times it's going to be gap support, or it's going to be maybe, a company comes out with great numbers, but they actually sell off afterwards. They go down, set a low, and then they start rallying. Well, that low could be a support. Anyhow, that's what I've got though, John. So Monday night, when we go over our portfolio with all of our members, this is a lot of the things that we're going to be talking about, coming up with what we believe are the best out there. So
Yeah.
if we got some questions, I'll be happy to answer.
Yeah. Just before we do that, if you like what you're seeing, hit the like button, subscribe to our channel. And Tom, we've got a lot of great feedback and comments from existing members. Thank you so much. And just before we get to a couple of questions, a few people had questions about the flash sale. Could you throw that back up?
Yeah.
Just one more time.
Yep. So here's where you see it on the website.
Yeah.
The top,
right. The flash sale right at the top.
Yep.
And anyways, this is as good as it gets. $300 off. By the way, I'd say 90% of our members, our annual members, you can sign up as a monthly member, $147 a month, but that's, times 12 a month, that would put you, I don't know, $1,700, $1,800. So you're better off to do an annual membership. You'll save 30%. And if you do it by tonight, we've already gotten a nice number, you'll get another month bonus. So 13 months, and you're going to get everything that you're seeing here, including admission to Monday's top 10 stock pick event, our quarterly market updates, and our market vision, and Tom's daily guidance. So tremendous. Do it. If you're going to really thinking about it, this is the best time to do it. Okay.
Yeah, John, also, it's a great time for new members. If you want to, come on board and check out how we do things over the next year, it'd be a great time to do it, get that bonus month.
Yeah.
But for any of our current members that are coming up with expiration anytime soon, I mean, this is one of the best deals that we've had out there ever. And so, give that some consideration as well. This isn't just for new members. It's also for any existing members as well.
And by the way, if you do renew, if you're an existing member, any remaining time is just added, to your account. So you're not losing any time. So You'll just have another 13 months if you sign up by tonight with Tom. All right, let's do a couple questions. I can answer this one. I think it pertains to the portfolios. Do you use leverage ETFs to beat the market? The answer is no.
I do talk about leveraged ETFs though.
Yes, you do.
Sometimes.
But as far as the portfolios go, no.
Yeah, no, never in the portfolios. We have an ETF portfolio, but no, we do not consider leverage. First of all, you should never hold a leveraged ETF for 90 days, in my opinion. That's not what they're designed for.
Right.
If you see a move and you believe that we're going to have a short-term move, you can get into a leveraged ETF and leave it in there as long as the market's going in your direction. But as soon as it starts to turn the other way, you don't want to be in a leveraged ETF that's choppy, that goes up, down, up, down, up, down, because over time, these leveraged ETFs erode. It's just due to the way they're put together. And the more volatile the area is, like semiconductors are extremely volatile. So when they start going through choppiness, you can see a lot of erosion, like the SOXL, something like that. Or even the NASDAQ, doing the TQQQ or the SQQQ, that's the 300% long and short respectively. Those leveraged ETFs can, start to lose value over time as well. So just be careful. Make sure you understand the best way to use those leveraged ETFs. And we do talk about that a lot.
All right. I think at one point you said we may find market with another leg down. Where might we go? And in the long term, does it really matter from your point of view?
I think there are two levels that I would really watch closely. Actually, three, but the third one's right in the middle of the other two levels. But I think the S&P 500, I wouldn't be surprised if we just keep going up and, move to all-time highs without, really a significant move to the downside. Because I said it before, I didn't believe we should have been going down in the first place. I think that it turned out more than anything to just be a lot of manipulation, especially this part down here in the first week or two of April. I mean, that was just absolute insanity. And then we started to come down a little bit. Look at these gaps. I mean, it's just consistently having these gaps and then the recoveries. And so there were so many stocks being accumulated back then. That's why I just don't see us going back down and taking out that low. I mean, I would be shocked. So anyway, to answer your question, I think this gap support area right around 5,800. If you remember, when we were down at below and during April, I kept talking about 5782, which was this gap support level, this low on January 13th at the open, and then this failure. After we broke down, we went back up and failed, could not close above 5782, and then we gapped above it. So when you come back down, I think this gap support at 5,800, that's the top of gap support. The bottom of gap support's about 5660, 5670, something like that. And then the rising 20-day moving average is right between the two, and 5782 is between these two. So I think you've got a range to the downside for any support on selling. And that would be, like I said, maybe 5670 or so up to about 5800. That's kind of the range. And at this point in time, that's where I believe our limit is to the downside. I just don't see us going back down below, say, about 5670.
Yeah. It's interesting. You hear all these analysts coming out and saying, "Oh, I think we're going to retest them." They want people to think that so they can, get involved when the market starts pulling back. Just ignore that. Here's a really interesting one, and I think it speaks to the whole idea of ignoring things that are maybe being set outside, because you've got the chart includes a lot of the stuff that's being asked. Here's a question, for example. I think interest on debt is going to pressure growth and cause us to have a not so easy markets to make money. So you can sit there and try to figure that all out, Tom, or you can look at the charts and see what they're telling you.
Yeah, exactly. I mean, news stories, it's not like you have an advantage. Everybody out there knows that the U.S. has a debt problem. We got the trade deficits, we got debt problem, we got all kinds of problems, and we've had them for many, many years. And yeah, they keep getting higher, but that's because, as time goes on, you get inflation. I mean, everything gets inflated. There are a lot of different ways you can argue market's going to go down because of this news or up because of that news. I follow the charts. I mean, I'm not smart enough to use all that other data. And honestly, I don't think anybody is, because I don't think it has much influence at all on where we end up going. I think it's based on Wall Street, what they're doing with their money. Yeah. And when you figure all that out, I think trading and investing becomes a lot easier.
All right. Okay. We need to wind this up, and then, everybody will have access to this recording. Do you give any weight to XLP leading on Thursday and Friday on a percentage basis?
XL what?
P.
Oh, XLP. Okay. No, not one day. I mean, we're talking about trends. I mean, what I would say is that I would have expected more strength this past week in some of the more defensive areas and less strength in some of the more aggressive and growth areas, simply because of Max Payne. I mean, we talked about it on Tuesday, and of course it never provides us any guarantees that the market's going to go lower, but there were some serious concerns with all of the in-the-money call premium that was out there this past week, that we would go down. And I said over the course of the next couple of days to a week. And usually what I look at is into maybe through about Tuesday of the week following monthly options expiration. And the reason I go out that far, I mean, obviously options expire on Friday, but many people will exercise those options and they'll buy the underlying stock to avoid having to pay taxes. And so if they do that, market makers are still on the other side of the trade. So it's not just about, bringing down that premium, but if the calls are exercised, market makers, instead of, being on the short side of the calls, they're now actually on the short side of the stock. And it still would behoove them for prices to move lower. Now, this is a short-term phenomenon that we talk about with Max Payne. I say a lot of times, you could have like just a quick drop, test the 20-day moving average. Most people would think nothing of it, but it could literally save market makers billions of dollars. And so you have to be aware of it. They didn't lose money because the market went up at the end of the week. They still are protected, at least they should be. If somebody's buying calls, market makers are selling those calls, and they should be buying the underlying stock, which is a covered call strategy. So you don't lose money when prices keep going higher. So I just think that, the fact that Friday we saw some movement back into defensive areas, I mean, honestly, I would have been expecting that earlier in the week based on Max Payne. And that to me wouldn't have left a mark as far as I'm concerned from a longer term or even more intermediate term call on the market. So I would have ignored it. And normally one day is not really what I'm looking for. I'm looking for like over the period of a couple months, like when I showed that chart of 2022 and 2025, the S&P going, from in November to January in 2022, and what we did from December to February in 2025. I mean, we're not talking about a one-day thing. Market, all of the big Wall Street firms are not going to reposition in a day. It's going to take a period of time. They have too many shares. So one day or 1 week is not doing it for me. It needs to be over a period of time, and we need to have some other corroborating signals as well.
Yeah. All right. What's interesting is we've seen, Tom and I have been doing this a while, and at options expiration week into the next couple of weeks, some strange things have happened. Now, this may not come Monday. It might be totally forgotten, but you just can't ignore the fact that right after the bell on Friday, Moody's came out, downgraded U.S. debt, and stocks and the Qs and the spiders really fell quite a bit after hours. Maybe it won't matter come Monday morning, but don't be surprised, for a couple of days to trap people in calls. And like you said, those people who exercised, the option, don't be surprised for a couple of days with the market stretch that we'll see a little bit of selling. But after that, it'll be back to business as usual.
Yep.
All right. We're going to go ahead, Tom. Why don't you go ahead and just wrap it up again? Last, mention of the flash sale. Go to our website, top, getting a great response. You'll save a lot of money, get a bonus month if you do it by tonight. It runs through Monday, but if you're going to do it today, because you'll get the bonus month. Come into Monday's top 10 stock picks where Tom's going to lay it all out. And again, if you like what you see, like us, subscribe, to our to YouTube. It really helps. Our community is really growing. Spread the word to people about earnings beats, and it'll allow us to Tom to continue to provide the kind of market guidance, independent, by the way, no Wall Street connections, totally on your side. I'm out, Tom.
Yeah, I actually I view us as an anti-Wall Street. I mean, I follow everything Wall Street does because that's how you figure out what's going to happen in the market. But yeah, these big Wall Street firms, they don't care about us. They're going to get out. And I've said all along, the biggest conflict, one of the biggest conflicts of my lifetime is watching what happens with these, with the stock market and how it's set up, for big Wall Street firms like Goldman Sachs. They can trade for their own accounts. They can trade for their wealthy clients' accounts. Then they can go on CNBC with their influencers, or I guess they call them analysts,
contributors,
I call them influencers. But they can go on onto CNBC, and they can tell you what you should be buying and selling. And then you go back to these firms. Goldman Sachs has a market making unit, and so they're back at their market making unit doing the exact opposite of what they're telling you to do on CNBC. They're taking the opposite side of trades. So it's kind of crazy. I mean, that's how they can manipulate us, and that's how they can build inventory for all of their different funds, and like I said, they're wealthy institutional clients, they're wealthy individual clients, and it's all done at our expense. So you can follow what everybody's saying on CNBC, or you can follow the charts and get out before everybody starts panicking, at tops and all. But anyhow, we try to make our services affordable as possible. So I do want to just mention this. Normally it's $997 annual, which is much better than the monthly rate. John mentioned it's like $1,800 a year monthly. It's $147 a month. So that's obviously very expensive to go that route. You should absolutely do the annual $997 instead of that. But we do these flash sales. We know, people are coming in here today on a Saturday, and they're listening to us. And, we want to try and give them one of the best deals we can possibly give them. And that's why we do this. We've been pretty consistent about doing these flash sales recently to try and get more and more people on board. Go back and follow my articles. Look me up on YouTube. I've got a lot of stuff out there that's been date stamped. The information's out there for you. And I didn't look at any of the comments, but I do want to echo John's thoughts and thank all of our members that maybe commented and about our service. I'm proud of it, and it's nice to have a good group working with us here at Earnings Beat. So, but that's all I got. And definitely subscribe to our channel and like the video, because we are trying to build this up, and that'll much more easily get done with all of you helping us there. Even if you don't subscribe or to our membership, become a member, you can still help us by spreading the word and building our community on YouTube. Have a great day, everybody. I'm going to go watch some golf. So I will see you all on Monday evening. Take care. Happy trading.